Hi, this is Ashutosh Bhargav. I'm the fund manager and head equity research at Nippon India Mutual Fund. I've been tracking the equity market for more than 16 years. Today, I'm going to talk about Nippon India Balance Advantage. Starting with the core idea behind the fund, diversification and proper asset allocation. Asset allocation is a powerful concept when it comes to financial. To quote Harry Markowitz, Nobel laureate and the pioneer of modern portfolio theory, diversification is the only free lunch when it comes to investing. Various studies, time and again, have highlighted that it is the key to long-term wealth creation. While most investors understand that asset allocation is important, due to various emotional biases, mainly greed and fear, many investors struggle to make optimal asset allocation by themselves. Systematic rule-based approach towards asset allocation is one way to address this challenge. Nippon India Balanced Advantage Fund is a dynamic asset allocation proposition. It invests in two asset classes, Indian equities and Indian debt. Rather than static or subjective allocation, the fund varies allocation across equity and debt depending upon the signals coming from various time-tested indicators. The fund uses an in-house proprietary model which combines select indicators to determine the asset allocation. Now, coming to the model, it's a mix of fundamental, macro, and technical factors like price momentum. Valuation is the fulcrum of the model. Other variables are supporting variables and have relatively lesser influence on the net equity allocation of the model at any given point of time. For valuation, we consider 1 year forward price to earning ratio of the index called MSCI India Index. We have 5 valuation buckets starting from expensive to average to cheap valuation based on the historical experience of our market. For assessing price momentum, we use a combination of moving averages. These may indicate an upward, neutral, or downward market trend. Recently, to make the model more robust, we have added 2 more important parameters, which gives us signals about global demand and liquidity condition. For global demand, we use a combination of signals coming from commodities like lumber, nickel, and copper price. Trend in these commodities may provide us signals from the strength of global demand perspective. Another factor which we consider is trade-weighted dollar index. In the context of emerging markets like India, strengthening US dollar generally seems to be negative for sentiment and flows towards the equity markets and vice versa. So the net equity allocation in this model is determined based on all the above factors. We run this model every day, and in case we see significant variation coming from the model, we can rebalance the model at any given point. However, as a general practice, we follow monthly rebalancing because we believe, as per our backtesting results, the results which come from daily rebalancing or monthly rebalancing are almost the same. And monthly rebalancing has lesser noise and impact cost versus the daily rebalancing. Talking about the fund strategy, typically equity or equity derivative constitute more than 65% of the portfolio and balance is in that portion of the portfolio. Net equity allocation is determined by the model, ranges between 30 to 80%. Lower valuation, higher price momentum, and favorable macro like strong commodities and weaker dollar leads to higher equity allocation and vice versa. For example, if valuations are below average, cheap versus the historical context, market price momentum is strong, and commodity prices are trending upwards. And along with it, US dollar is on a weakening trend, then the model may suggest as high as 80% net equity allocation. Our equity investment universe is mostly listed large and mid-cap stocks, which have derivatives with them. These are primarily the top 200 market cap companies. Minimum 65% of equity exposure is into large cap in this product. We have balanced portfolio, which is well diversified across sectors and stocks. In terms of style, we are style agnostic when it comes to managing the equity portion of this. In the fixed income part of the portfolio, we follow a very conservative investment strategy with no undue duration or credit risk taking. We focus on the shorter end of the curve, and most of our investments are into AAA rated or equivalent instruments. Since the fund is categorized as equity-oriented fund for all taxation purposes, the gross equity exposure is maintained over 65% all the time. If the model suggests lower than 65% net equity exposure, we use hedging through various stock and index future to bring down the net equity exposure at a level prescribed by the model at any given point of time. In sum, the fund offers a very good mix of equity, debt, and arbitrage, which changes with the market environment and what is prescribed by our own proprietary model. Overall, Nippon India Balanced Advantage Fund endeavors to deliver steady returns across market cycles. We believe it's an all-weather proposition and may be a part of investor core portfolio. In terms of return per unit of stress taken or risk taken by the investor, this fund may do a good job. We believe Nippon India Balanced Advantage Fund is ideal for conservative investor or the first-time investors who are coming to the equity market seeking equity exposure with relatively low volatility. Thank you and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.